Good evening, ladies and gentlemen. Please ensure that your mobile devices are switched to silent mode as we will start momentarily. For our online attendees, welcome, and our event will begin in a few minutes. Please note that this session will be recorded for informational, educational, and marketing purposes. Okay. Let me begin by wishing everyone a very happy new year. Happy 2025. So on behalf of Nanyang Business School, the Principles for Responsible Investment, and also the European Corporate Governance Institute, I'm very delighted to welcome you all to our inaugural lecture of NBS-PRI-ECGI Public Lecture Series on Sustainable Business. My name is Yusha Zhou, and I'm assistant professor here at Nanyang Business School, NBS. I have the privilege today to present our event organizing committee to be your MC for today. The NBS-PRI-ECGI Public Lecture Series is a brand new global initiative starting this year, 2025, aiming to facilitate knowledge exchanges among academics, practitioners, and also policymakers in sustainable business. Every month, we will host a public lecture either in person here at NBS with live stream through Zoom or virtually via Zoom. Each lecture will feature a leading scholar to present an overview of academic research with a specific topic in sustainable business for around 60 minutes, followed by an industry expert with academic insights with practical experience to moderate our 30-minute Q&A. After each event, we will also summarize the content in a blog post, and with the permission from our speakers, we will share the recording and slides online to create a public knowledge repository on sustainable business for all. So we have an exceptional lineup with renowned academics confirmed from January to June 2025, with more speakers and moderators to be announced in the future. These speakers are from various disciplines, such as finance, accounting, strategy, and law, aiming to encourage interdisciplinary dialogues and also collaborations to address sustainable business issues with a more holistic perspective. So today, to officially launch our exciting and prestigious lecture series, it is our honor to invite our Dean of NBS, Professor Jun Yang, to deliver the opening remarks. Jun, the floor is yours.
Thank you, Yusha. Good evening, everyone. Thank you for coming here to join us at NBS, Nanyang Business School. And thank you, everyone, if you are dialing in online. Good afternoon. If you're in Europe, I don't know how many people are dialing in from US right now, but good morning, early good morning if you're from the West Coast. So at this beginning of a new year, I think this is a perfect time to launch this exciting new series on sustainable business. This is very dear to my heart. And this is the opportunity that we can really bring academics, practitioners and policymakers together to have meaningful discussions and exchanges on critical questions on sustainability-related issues. And first and foremost, I want to extend my sincere appreciation to our partners. So Yuxia already mentioned, one is United Nations sponsored Principles for Responsible Investment. We call them PRI. In Singapore, we tend to use these abbreviations all the time and they confuse people online. So PRI is Principles for Responsible Investment. And another important partner is the ECGI, European Corporate Governance Institute. So we are happy to work together in launching this important series, and they are instrumental in helping us to start the series. So for today, in this audience, in this auditorium, we see quite some participation. Actually, overall, there are more than 800 registrants from 60 countries. So many are dialing in from online. So this highlights the growing global focus on sustainable business and its importance for us to work together in addressing these challenges of our time. So as Yuxia mentioned earlier, so here we're really connecting academics, like today's keynote speaker, with practitioners, like today's moderator, as well as policymakers. Some of the audience who are dialing in right now, and hopefully in the future in the audience as well, are the policymakers. So they can take the most recent cutting-edge academic research findings into their consideration of policymaking and into their decisions on how to direct money, to direct resources, to work together to deal with these global challenges. And here at NTU, Nanyang Technological University and NBS, we not only talk about sustainability, we also practice sustainability. So one thing we're very proud of is sustainability is embedded in every single discipline that we have. And actually, as of August 2024, we launched the first executive master in sustainability management. So we have 43 chief sustainability officers or alike from around the region to participate in that executive master program. And we had held, I think Matt started that, decarbonization and Dengxin forum last summer. And in November 2024, Daniel is also in the audience, launched Carbon Academy. So these are our commitment to contribute to this collective effort to solve these global challenges and make our business sustainable. On top of that, we have at least two centers. One is Center for Business Sustainability, another one is Center for Sustainable Finance Innovation. So we are fully committed to this mission that we are talking about today. On top of that, this particular building where you are in, Gaia, we just won one of the most prestigious awards in December 2024. I'm going to butcher the French, which is UNESCO, this is United Nations, Versailles Grand Prix for, if you don't hear anything of that, is sustainable architecture. So we're in that category. It is to celebrate the innovative and eco-friendly design of the building. So for today, for this inaugural lecture, we're going to talk about climate risk in financial markets. So this is more at the forefront of many discussions, and climate risk, understanding of its impact on investment would provide us opportunities in solving many of the problems we're going to face. And today we are honored to have Professor Laura Starks from University of Texas at Austin. Laura has been my role model for many years, and Laura has many groundbreaking research in the area of sustainable finance, sustainable business, and more recently, climate risk-related studies. And moderating today's event is Dr. Joanne Q. She's the director of ESG of East Spring Investment, and she has pocketed 13 years of experiences in sustainability. So her expertise will enrich today's discussion. So in the coming month ahead, you're going to listen to topics on ESG performance. For example, we've been talking about ESG for so many years. How do we evaluate the performance? Is there some tendency of greenwashing? So that's coming up. You're going to listen about climate resilience as well as emerging trend in finance. With that, thank you again for embarking on this important journey with us. And I hope this session would inspire more meaningful discussions, so hopefully some collective effort in the future for us to deal with this globally important and challenging issue. So now let me hand the floor and podium back to our MC, Assistant Professor Yuxia Zhou, to introduce today's speaker. But before that, Yuxia has been amazing in putting this series together with a very short time, within 3 months. Let's all give Yuxia a round of applause. Thank you.
Thank you so much, Professor Jun, for your inspiring words and for setting the stage for today. Now, let's move forward for tonight's program. So to set the tone for this series with distinction, as Jun mentioned, we are very delighted to welcome our inaugural speaker, Professor Laura Starks. So Laura is the George Kosmeski Centennial University Distinguished Chair and also Professor of Finance from McCombs School of Business, University of Texas at Austin. She's also the current chair of the Academic Network Advisory Committee at PRI and also a research member at ECGI. So she's really uniquely positioned to be our inaugural speaker, marking this important collaboration among all three institutions. So Laura has made a significant contribution to the whole academic finance community, served as the president of all 4 major academic finance associations, such as AFA. And also, she has won numerous awards, such as the Moscowitz Prize for Outstanding Research in Sustainable Finance. So her work has played an instrumental role in shaping our understanding of sustainable finance, especially climate finance. So today, she will deliver to us a public lecture on climate risk and financial markets, value versus value perspectives. So Laura, please welcome to the stage. And to the audience, notice that we have a 30-minute Q&A session following the lecture. Therefore, we invite you to note down your questions and to raise your hand during the Q&A session, either in person or through the QR code displayed on the screen later. So now, floor is yours, Laura.
Thank you so much, Yuxia, and thank you, June. I'm so pleased to be here. I love Singapore. I've been here many times in the past, and I'm very happy to be here now. Although I'm not sure my jet lag is over. So what I wanted to talk about in terms of the climate risk and financial markets, the value versus values perspectives, is I wanted to bring in the academic research and what the academic research tells us about the climate risk and financial markets. So as we all know, there exists increasing carbon in the atmosphere. This is a graph that shows from 1960 how much the carbon in the atmosphere has been increasing at Mauna Loa laboratory, and it in December, is over 400 parts per million. So it's really increased over time. We all know this. And the problem is relatively recent. There was a lot of variation for 800,000 years, but it was not until 1950 that it started really going up and has not come back down. And so this has led to increasing temperatures and climate risk for companies and their investors. So if you think about climate risk, a number of people think climate risk is an environmental risk, but it's more than that. It's a social risk, a governance risk, and a strategy risk if you think about it. And what we still need to understand for a given investor is how much of this risk that they're looking at is due to their financial concerns and how much of this is due to their non-pecuniary concerns or their taste and preferences. And you know, what is it that drives these concerns? And that's the value versus values, or both, that I want to talk about. So if you think about value versus values, the value perspective is that sustainable corporate practices and sustainable investing can actually have value relevant effects. Whereas the values perspective is that the sustainable corporate activities and sustainable investing develop from the non-pecuniary preferences. For example, that you may not want to be supporting corporate activities that you don't agree with, that you find objectionable. So again, we need to separate the investor's motivations if possible. So if you think about the value motivations, there's the risk management concern. So, you know, reducing and understanding the sustainable finance risk exposures, and then return opportunities that can come from the sustainable risk issues. The values perspectives, again, has to do with preferences, but it also has to do with making an impact, that people care about making an impact. And there aren't clear boundaries, but with these, you know, they can also go together. People can have both value and value concerns. Okay, so let's talk about the academic research. It's provided insights into these motivations from both institutional investors as well as retail investors. So I did a survey of institutional investors about climate risk and how they thought about climate risk with my co-authors, Philip Kruger and Zach Sautner. And I think when we look at the motivations that we found 7 motivations that were the highest on there. And you can see both value and values in these motivations. So for example, in terms of the value, it's that some of them said it's beneficial to investment, it reduces overall portfolio risk, and it reduces tail risk. Others had values, and I should point out these aren't mutually exclusive, so people had different ones, a combination of these. But the values were, it's a moral, ethical obligation, and it reflects the asset owner preferences. And then there's also what I would call a blend. It protects our reputation. That could have both value and values connotations, and it's a legal fiduciary obligation. So there's lots of academic evidence on the value and values motivations. If we look at retail and institutional investors, we find that they select higher ESG funds and stocks due to both value and values considerations. So for example, longer-term institutional investors have stronger apparent preferences for the higher rated ESG stocks as compared to other investors. So this graph is from a paper research I've done with Parth Venkat and Chief-A Zhu. And what we found, among other things, is that the ESG score of the portfolios, which we calculated, was higher for the long-term investors than for the short-term investors. And we found a monotonic relationship when we looked at asset managers, pension funds, mutual funds, insurance companies, and banks. When we looked at just mutual funds, we found the same thing, where the ESG score of the portfolio were higher for the long-term investors than the short-term investors. What's also been found is that shocks to fund sustainability reputation suggest that investors react to ESG scores. And then there's also evidence that shows that the mutual funds that have an objective of ESG or SRI actually have lower flow performance sensitivity than other types of mutual funds. So that seems to reflect some values preferences. There are also other surveys and experiments on U.S. populations have found among Vanguard investors that there was a percentage that 48% that had no demand for ESG. But then there were those that had non-pecuniary preferences, about 24%. There were those 22% wanted to hedge their climate risk, and 6% actually had financial return expectations from investing in ESG funds. Then there's also some experimental work I've done that there's this asymmetry between investors in terms of their negative versus positive externalities. And what we found is that their asset allocation decisions were much more affected by their concerns about negative externalities than positive externalities. There are also some surveys and experiments with Dutch investors, which have been very interesting and have provided us with information about retail investors' values motivation. So the SRI funds are held primarily due to social preferences and signaling, and they found limited financial motivations for these holdings. Pension fund participants, they found, want their plans to actually engage in more responsible investing activities. And this had to do with the participants' non-pecuniary preferences. And then they found that there was investors' willingness to pay increases in the altruistic attitudes of these investors. Some more academic evidence on the motivations across values investors. This is a brand new published paper where they found that they pointed out that there's, and again this goes back to the values investors, as I talked about earlier. You may be a values investor because of your preferences. You know, you want to align your portfolio with your values and goals, or it may be because you want to make an impact. You want to change the world in some sense. And what the authors found is that investors seek to align their investments with their social values, but somehow but they found no evidence that the investment choices were driven by the social impact of the investment decisions. So it really was much more with aligning the values. Okay, so is there a way to explain these differences? Can we understand more by looking at differences across countries? You know, particularly because of differences in cultural norms. So if you look at the number of sustainable funds, and this is from the third quarter of 2024, so this is the most recent data, there were 7,609 sustainable funds, and this can be compared to 2020 when there were less than half those number of sustainable funds. And every region had an increase in the number of sustainable funds. But one thing that's striking about this is, if you think about it, which region do you think has the most number of these funds, and how many more do they have? Europe. And if I did a pie chart here with the amount of money in sustainable funds, Europe would have an even bigger share of this. And if you think about it, like the mutual funds, these are all mutual funds. The mutual fund market in the U.S. is much bigger than that in Europe. But when you're looking at the ESG funds, it's Europe that dominates this. If we look at the flows, and again, this is from Morningstar and their recent report, you can see the flows have been positive in Europe. And the dark green at the top are into passive funds, and the blue is into active funds. So you can see both types of funds have been having positive flows over the last few years. If you look at the USA, you see a very different pattern of the flows. And you also see this difference across the passive and active flows. If you look at Japan, you can see they've also had a lot of outflows in recent time periods from their ESG funds or sustainable funds. But if you look at Asia without Japan, you can see that there are a lot of flows going into the ESG funds, and particularly a lot of flows going into passive funds. And then this shows the differences across the countries in that Asia without Japan. And you can see that there's quite a bit of difference across the countries in Asia versus Japan. And again, all of these charts come from Morningstar. Okay, so why the differences in this recent ESG interest across countries and regions? My hypothesis is this is driven a lot by differences in cultural and social norms, including politics. So we know from academic research that culture and social norms affect firms' environmental, social, and governance decisions. So studies have found that foreign institutional investors affect companies' governance quality. They affect companies' environmental and social performance when they come from countries with strong norms toward environmental and social issues. There's also been found that firms' environmental and social performance is related to country characteristics, economic development, law, and culture, and that firms' environmental and social ratings are correlated with the country's legal origin. So we have these differences across countries that have been shown from the academic research. And then finally, signing on to PRI depends on a country's cultural values. That's also been found. Okay, so this map, which I did, it looks at where dark green is where the companies. This is from S&P environmental scores, and the darker the green, the higher the average in that country for the environmental scores. And so you can see the area, not surprisingly, that has the most, which is Europe, has the companies with the highest average environmental scores. And then you can see differences across other areas. Also, if you do just a simple correlation between the Yale Environmental Performance Index, which is capturing policies across countries, and then compare that to their average company environmental scores, and you can see that it's about, it's over a 50% correlation. So there is this relationship, I argue, that the social norms matter for companies' decisions, and the social norms affect the laws and rules. Okay, so what this shows is the average environmental score by country. So before I showed you the picture, this is showing it in terms of by country. So this is Singapore, and and this is the U.S. So you can see, and if you could read this over to the right, it's almost all European countries. The same thing holds up for the social scores. Again, Singapore is higher than the U.S. And again, all to the right, almost all to the right, not all of them are from our European countries. And then the governance scores, It's the same kind of thing. Okay, so academic evidence, and I know I'm standing here from the US and from Texas. And so you're thinking, well, what about the politics in the US? Well, academic evidence shows that politics matter for climate risk. There's a paper that shows that environmental policy uncertainty has an effect on pollution, premium for high toxic emission firms, and it's a systematic risk that when there are regime changes, there's an effect. And then there's also a paper also that shows regime changes through presidential elections and appointments are associated with stock price changes for carbon intensive firms as well as their counterparts. So there's also more evidence that politics can have asset value effects. If you think about the Paris Agreement, nations signing to take actions to combat climate change, and those actions require increased regulation. And the increased regulation then is going to affect the firms. So this is from a paper I have with Lee Seltzer and Jifei Zhu. And what we looked at is what happened to the credit ratings of bonds, and these are US bonds, around the announcement of the Paris Agreement. And these are difference in differences test. For high carbon emission US firms compared to other firms. And what you can see is there's no pre-trend. You know, they pretty much were the same in terms of those are the credit ratings over time compared to other firms. But then there was a big drop, a significant drop after the Paris Agreement. So this provides some evidence that things like the Paris Agreement can have effects on firms, and we argue this comes from the climate regulatory risk. There's also evidence that with option markets, investors are pricing climate policy uncertainty. And so what they find in this study is they look around, again, this is politics, they look around the previous Trump election in 2016, and they found that a firm's total carbon emissions are positively associated with tail risk. I mean, in this case, the tail risk went down. And then, there's also the issue of politics and climate risk disclosure. So surveys shown that investors believe climate risk is important, that the disclosure is important. And when France legislated institutional investors must disclose their climate risk, in 2016, the climate risk disclosure of firms that were owned by many French institutions disclosed more. So there was this effect. When France, they did not require this of the firms, they required this of the institutional investors. So the implication of these results is that the institutional investors were demanding, influencing their firms to disclose more so they could disclose appropriately. And then politics can have costly outcomes for taxpayers. So for example, in Texas, they passed legislation that kicked out banks that said they wouldn't loan to firearms manufacturers anymore. They passed a law in Texas saying, okay, well, those banks cannot do business with any governmental entities in Texas. And so they kicked out 4 of the largest investment banks in the municipal bond markets. So all the municipalities in Texas could not use these 4. And what this study found was there was a significant cost to the issuers. The issuers of the municipal bonds had to pay more because, you kicked out the biggest players in this market. And so that's a cost that's being borne by Texas taxpayers. Okay, so there's also academic evidence on institutional investors' actions and influence with regard to climate risk. Going back to this survey, they also reflect the value versus values perspective by looking at how the investors consider climate risk in their portfolio decision making. So, so what we found is that, you know, they would analyze stranded asset risk. The first one, which for some reason, not everything is showing up on this. The first one is measuring carbon footprints. But what I wanted to really talk about was divestment. If you look at all these different ways that they, and again, half are missing, but you can go to the paper and find them. But if you look at all the different ways that these institutional investors incorporate climate risk, notice that divestment is the lowest in terms of percentage. So exiting the firms is not the most popular way to do it. And if you think about motivations for divesting fossil fuel companies, there is both the values investors' considerations. So for example, their preferences, they want to avoid contributing to climate change. And for many, it's an attempt to raise the firm's cost of capital so that they will change their ways. So those are two of the values investors' motivations. If you look at the value investors' considerations for divesting from fossil fuels, you find what they're interested in is a risk and return trade-off here. So it may be diversification considerations. For example, the Norwegian Sovereign Wealth Fund, they get their money from the oil that they're pumping out of the North Sea, and so they decided for diversification purposes that they would divest of some of their fossil fuel firms. There's also the stranded asset risk, that people are concerned about stranded assets, and so they want to divest because of that. And then just sector rotation is a reason for this. In terms of the empirical evidence on divestment exclusion, there is little that shows that it's beneficial. For the most part, the South African divestment many years ago, the research that's been done on that found little discernible effect on firm value from that. So the firm's cost of capitals were not being increased at that time. There's a study that finds that exclusion can be costly to pension plans and endowments. It can be effective under certain conditions if you have investors who are very conscious about environmental and social issues. And then another finding is that institutional portfolios are being decarbonized because of portfolio reweighting rather than through shareholder engagement. So in terms of shareholder engagement, in our survey, we asked about this shareholder engagement, and we found that the types of engagements that they did, such as discussing the issues with management, were very similar to in a previous survey we did on corporate governance. It's the same kind of engagements. So what happens with engagements? Okay, so I want to talk about two things on evidence that we have. One is on disclosure and what that has to do with engagements, and the other is on operational and governance changes by the firms when they're being engaged by institutional investors. So one of the things we did in this survey was we asked, how important do you consider disclosure on climate change issues? And what we found was, if you add these up, 79% thought that disclosure on climate risk was at least as important as financial disclosure. And we also found that there were certain characteristics of these types of institutional investors that thought disclosure was important or more important. And so, it was those that had, not surprisingly, were ESG investors and other types of characteristics such as that. Okay, so there are two possible goals of mandatory climate risk disclosure, and this comes from a paper by Christensen, Hale, and Luz regarding corporate social responsibility, or ESG. So their first goal is that this gives the investors the information that they need. So basically, single materiality. How does a climate change affect the firm? This is a value perspective, right? That's first goal. Their second goal is that again, this is to drive change in the firm's climate finance behavior through the disclosure regime. And so basically this is double materiality, where you're concerned about how climate change affects the firm and then how the firm's action affects the society and the environment. And this second one is a values perspective. So we have both value and values perspectives in terms of the goals for mandatory climate risk disclosure. So we looked into this in a study, and we found strong evidence that the disclosure demand is affected by climate-specific disclosure costs and benefits, and that the investors recognized that, for example, if it's costly because the information is highly proprietary, then there's less of a demand for the disclosure. On the other hand, if you're a large firm and you have more ability to handle the cost, we found that there was more demand for disclosure. And we also found there was more demand for disclosure for the highly carbon polluting industries, not surprisingly. Okay, in terms of investor engagement, well, this is the study where we looked at large investors' engagement on E, S, and G issues. And so this shows, the large number of engagements over time. And there were 1,443 of these engagements. And so what we wanted to find out was, how does this affect the risk of these firms to have this engagement? Does it work for shareholders to engage with the firms that their portfolio companies? And so this investor had different milestones. For example, did the company recognize what they were asking for? Did the company do anything about what they were asking for? So we were able to get very defined data on what this investor did and how the companies responded. And so then we looked at the downside risk measures after the engagements to find out what happened. And we found that the ESG engagements resulted in reduced downside risk. Whether we use value at risk as our measure of downside risk or lower partial moment. The risk reduction effects, we found they were stronger for the more successful engagements. So the higher they got to the milestones, like getting the company to respond and do what they ask, there was greater reduction in downside risk. We also found that the effects were strongest for the environmental issues than for the social and governance issues. Okay, so I want to talk a little bit about the academic evidence on transition risk effects in the financial markets. So one of the issues here is, how do the researchers define green versus brown firms? So ESG ratings is one. Environmental ratings in particular. So some use all the ESG ratings, some use just the environmental ratings. Some use green revenues to define this. And then so those are mainly, the top three are mainly defining the green. Then there's a series for defining the brown, using total carbon emissions of firms, using the total carbon emissions of the industry, using emissions intensity measured with sales as the denominator, using emissions intensity measured as assets as the denominator. And so those are the main, these are the main ways that researchers have defined green versus brown. So does the definition make a difference? And I'm going to show you that it does. So for some analysis, the difference in the definitions for green versus brown, it doesn't change the results. So going back to my study, where we're looking at the change in credit ratings around the Paris Agreement, you can see that, I don't know what that says, so. So you can see that whether we use below median environmental ratings, the top quartile carbon intensity using learning surprises to show some of the results. So this is the one with using the green revenues and from Klausman, Kruger, and Matos. And what you can see is stocks with higher green revenues outperform. If we look at the Pastor, Stanbaugh, Taylor paper again, and this is dividing the green and the brown into two different groups, you can see again that the green outperforms. So you find this, and both of these, this is realized revenues or realized returns. So both of these are using past data to look at, you know, how stock returns are related to a firm being green or brown. The one thing is, you know, that so they find green stocks outperform. They're using the MSCI environmental rating, and MSCI uses industry adjustments. So some of these green firms actually are brown firms. So you know, it's not a defined definition. Also, this paper by Caroli, Wu, and Zhang show the same thing. Green firms defined using the MSCI environmental rating outperform brown firms in the U.S., which is what the previous two papers were using U.S. But then they used it globally, excluding the U.S., and you see that this premium is driven by U.S. firms. They don't find a premium or much of one globally. I think this wasn't significantly different on the one to the right. Okay, so a question that's been asked is, well, where does the green premium come from? And the green premium argument that's made by Pastor, Stanbaugh, and Taylor, or Ardia and co-authors, and this is a chart from Ardia and co-authors, and it shows the media climate change concerns index, which comes from picking up the news. And so they show this relationship between both of these papers show a relationship between the climate change news and the carbon premium, using the environmental ratings as their measure of green versus brown. This is also consistent with a paper that is looking at the during conference calls how much reference is there to climate risk. And so if you look at this, again, looking over time, you find the same increase as the media concerns in terms of this is showing institutional investors' concerns during conference calls, asking about climate risk issues. So the work using E-ratings or green revenues to look at the differences in stock returns, it basically agrees. There's not a debate about this. But if you look at the researchers using the relationship between returns and Brown firms using emissions to define it, you find a big debate. They don't agree. And a large issue of this is how to define green and brown firms using emissions data. So, an example of the different definitions that's been used. One is using toxic emissions from EPA data and then normalizing it by assets. So it's basically, an emissions intensity, but using assets. There's also using scope 1, 2, or 3 emissions, total emissions, so absolute emissions, and then using scope 1, 2, or 3 where it's being normalized by sales, so a carbon intensity measure. And then there are other papers that have used both carbon intensity and total emissions. And so this is kind of the classic paper by Bolton and Kasperchik, where they find, the orange is scope 1, the gray is scope 2, the yellow is scope 3, and they find this relationship between carbon emissions and stock returns. And so they argue that this is a risk premium on carbon emissions. So the question is, well, why should carbon emissions be related to stock returns? And their arguments are as follows. One is basically what I would call a value perspective, and that's the transition risk. And so, it's particularly the regulatory risk that arises because higher carbon emissions, you have further to get to net zero. So you are more exposed to the regulatory risk and the technological cost of getting to net zero. So higher carbon emissions implies there should be higher returns to compensate for this additional risk. Then emissions growth reflects the speed of a company's transition towards zero carbon, and so it can be interpreted as a risk factor. So this is the value perspective. We can also have a values perspective, and so investor avoidance of high carbon emission firms because of the of preferences that you don't want to contribute to what's happening. Now, this does require that there's a sufficient number of these values investors that care about this, the green investors, as several theories show. The earliest one is that by Heinkel, Krauss, and Zechner. So this perspective is aligned with this idea that investors care about this, they divest, and they drive up the cost of capital. So again, this is a values perspective. And then the third one is that simply there's mispricing and that you're getting these relationships because of mispricing. So these are three arguments for this relationship. A finding that's consistent with the Bolton and Kasperchik finding is using the EPA toxics emissions. And again, this paper finds, and they use the Fama-French factor analysis, and they find higher returns and argue there's a pollution premium. There's also a forward-looking measure. This is a relatively new paper where they're calculating a carbon beta. And they calculate the carbon beta by using a pollutive minus clean portfolio factor along with the other Fama fringe factors. And so what they find is that the stocks that have high carbon betas have lower returns when there's more climate change news, when there's abnormally high temperature, and when there's exceptional dryness, i.e. a drought. And so they say, look, there's a carbon risk premium on these stocks. It's a little over 1% annually for each standard deviation increase in the carbon beta they calculate. And this is consistent with both the Bolton and Kasperczyk and the Shu et al. Paper. Oops. But there's also opposing empirical evidence on the relation between carbon emissions and stock returns. So this is a paper by Zhang that's forthcoming in the Journal of Finance, and you can see it's the opposite result of what you get from the Bolton and Kasperczyk. And also there's a paper by Aswani and co-authors in the Review of Finance that they have very similar results. So we have these two different debatable results. This shows the if you look across different countries. So this is Canada, France, Germany, Italy, Japan, United Kingdom, and United States, and then the average across the G7. And you can see that this carbon premium varies a lot if you're looking at different countries. And so, again, the question is, why do we get these different results? Well, here are the challenges to the test. First of all, there's a question of carbon intensity versus absolute carbon emissions. Should you normalize by sales or assets? And so that really makes a difference. If you use carbon intensity, you don't find the relationship. If you use total carbon emissions, you do. And so depending on which authors you talk to, you get differences in which you should use, the carbon emissions or the carbon intensity. The sample periods vary because the data isn't available for long periods of time. There's also this question of selection bias. If you're only using, and there's this debate, should you only use reported data or should you also use imputed data from some of the information providers? And so some say you should only use reported data, but this is voluntary disclosure. So it seems you're going to have selection bias. So one question is, which is worse, the selection bias or the using this imputed data? And the imputed data depends on firm characteristics and industry characteristics. That's how it gets imputed. And so then another question is the disclosure lag. There's an argument about that. Zhang says the disclosure lag is very long. Kasperczyk says, no, that's not true. It's only about 5 months. He's looked into it. And then over this sample period was a time when oil prices had a big drop in 2014 and 2015, and then a big increase a few years later. And so, how do you adjust for the oil prices? So I think it's important to take these things into account in trying to figure out these. And again, there's this differences in results between total carbon emissions and carbon intensity. And so you can actually go to the Review of Finance from last year, and the authors have this debate within the journal, so you can make up your own mind about who you believe. Okay, so in conclusion, there's lots of academic evidence, which I think helps us quite a bit in terms of thinking about investors' perspectives about climate risk in financial markets. And it comes from a number of different variables. The other thing is climate risk. The evidence implies that climate risks are important investment risk with financial implications. The risk have started to materialize, especially the regulatory risk. Investors' motivations depend on both the values and value considerations. Investors are using both exit and voice regarding these risks. Investors value and demand climate-related disclosures. And again, there's still debates on whether a carbon risk premium exists in the markets. So thank you very much for listening.
Thank you, Laura, for your very enlightening lecture. So I find it really, really helpful to have a systematic view of how the research has evolved from a person who knows the field so well. So we now transition to our moderated Q&A session. So our inaugural moderator today is Dr. Joanne Kyu, Director of ESG at Eastspring Investments, which is actually the largest PRI signatory in Singapore. So Joanne brings a wealth of industry expertise in sustainable investment, not only from her current role at Eastspring, but also from her previous experience from Standard Chartered, the Asian Infrastructure Investment Bank, and Temasek. So before her industry career, Joanne was actually a researcher in sustainability science with a PhD from University of Tokyo. So Joanne's unique expertise bridges both academic research and industry experience, making her an ideal moderator for our inaugural session. So now, Joanne, welcome to the floor, and please take it.
Try to get this on. I think everyone can hear us now. I wanted to start off by thanking Prof. Laura for a very enlightening and very detailed journey throughout the whole sustainability and climate, maybe investment landscape. Maybe just a quick summary. I know there are so many important points that Prof. Laura has touched on. Two things as a practitioner that really hit very close to practice and to heart are two main considerations. One is that there is that values versus value approach to sustainability and climate. And that correlates with a whole vast variety of investing styles and products that not only the retail and institutional investors and asset managers like Eastspring, and I'm sure others as well, the big names like BlackRock and USA, will all be thinking about how then like value type of impact investing, does it make sense versus something a little bit more like passive, like a climate ETF or climate fundamental fund? How does this all sort out in the whole values and return spectrum? And another big thing that I pulled away from the lecture was also definitions and the need for clarity. So I think at the start of ESG 1.0, where there were a lot of ESG funds, I think that's where we saw the term first come into the industry. But now there's a lot more demand for sharper definitions like climate funds. I think Laura showed very interesting graphs of ESG fund flows, and I was also wondering how that may look like on climate fund flows more specifically. And I think Laura also showed a few very enlightening slides on green and many ways of defining green. Is it an environment score, a climate score, or maybe what the EU taxonomy and ASEAN taxonomy defines as green activities, which can then be correlated to revenues and companies. So I think this specificity is very much coming to the field. And today we are very excited to discuss a bit more in the Q&A session. Maybe before I open it, just a quick reminder that anyone can submit questions on the QR code link on the screen. So just scan it with your phone and it will come into the iPad and we can continue to discuss it here. But maybe let me kick off with a first question first. I think, Laura, you are really a deep practitioner and academic in this field as well. You have listed so many different resources and also talked about regulations and what's out there in the market as well. this field may be nascent, but there's so much resources and sometimes conflicting ones, like the few studies you have ended on earlier. Will you say that, how will you understand this landscape? Is it too confusing? Are there sources that you feel practitioners, academics should look for first? Or is it still, despite its whole richness, not enough? Yeah. What do you think?
I think we certainly need more data and more of an understanding, and we need more research because again, the research doesn't agree, and so it's difficult to come to a conclusion with this.
Got it. Yeah, I think so. Despite all this climate data, all the evidence, more could still be done. And I'm sure a lot of you on the call or in this room will also be contributing to this whole climate discourse. Another question that I would like to field will be maybe a little bit of the elephant in the room, getting it out of the way. Laura talked a lot about the balance between values and value investing in terms of climate change. How has this balance changed over time, over the years that you have been practicing climate change, and especially in light of the discourse that has been coming on the field in your home country more recently?
So I think, I think early on it was mainly values, and then people started recognizing the risk that come from environmental activities, social activities, and governance activities of firms. And so I think there's much more, and in terms of climate risk, I think there's much more of a value approach in recent years. I think the confusion that happens is because a number of people think that it's all driven by values, and that values shouldn't have an effect on pension fund investments and other types of investments, but there is a lot of value, and then people who have preferences should be allowed to invest the way they want to. So
That's very interesting. Are you just picking up a little bit more on that? Are you seeing any difference between the value and values balance between, even in the United States, between the institutional investors versus the retail investors, like the man off the street?
There is, I think that institutional investors are very worried about fiduciary duty and the perceived fiduciary duty, but then they also have to worry about the risk that they're taking on. The retail investors, I think, and that Vanguard study showed there are a number of retail investors that are only interested in value, but then there are also a number that are interested in the values. And then looking at the studies of people from the Netherlands, the pension participants, there are a lot of values investors there, according to these studies.
That is interesting to know, because that is a lot more similar than we thought in terms of the retail and the institutional landscape, because sometimes people would think that institutional investors are more, for lack of a better term, like with inverted commas, more professional practiced and so on. But sometimes when it boils down to what they care about, what they invest in and see promise for the future, sometimes things seem quite similar, isn't it? Yeah. Yes, I think any questions from the audience that you would like to just shout out before? I do have quite a question bank here, but I would like to give the floor to the audience just in case you have something to ask. Yes, there's one right at the back.
Hi, Professor. My question is about having a consistent set of measurements, because you quoted like MSCI, EPA. So for any investors, is there a globally recognized standard that we could use as a measure to determine, like, for example, an area of business that we can actually use to define the standards that these particular funds or firm are actually consistent in the way that it is, because there's a lot of greenwashing coming on, like you mentioned as well. My definition of divestment is more or less like laundering their ill-gotten profits from, say, like petroleum, just to make themselves look good in terms of being green. So what are your thoughts about that? Thank you.
I wish I could say there's a standard measurement, but I think again there's just disagreement on what green means. I think the EU taxonomy has been developed to try to get more consistency in these standards, but there's still disagreement across investors, across regulators, across ratings agencies. And in fact, if you look at the rating agencies, the ESG rating providers, and you look in detail at, like, say, their environmental ratings, they have there's a lot of variety in what they think is important.
Yeah, I think that's a very good question. Also, maybe adding on just a little snippet, food for thought when it comes to taxonomy comparability. The EU taxonomy currently now does not have even a transition component, but if you look towards the ASEAN and Singapore taxonomy, which have this amber transition component, if you compare those, actually all of them say different things of what really qualifies as transition. They have different sunset dates, and they also have different like activity, let's say greenhouse gas life cycle emission threshold. So yeah, to your point, it's not as uniform a field as it is now. And I think to your answer to the first question, I think we do need more work, more studies on trying to find a data set that's unified enough for maybe for companies, for investors as well. There is maybe a pick up another question from the audience in the middle. Someone's coming with the mic.
Hi. There is a debate as to how much regulation around disclosure is too much, especially in Europe in terms of some of the requirements around climate risks or SIFDR and stuff like that. But given what you've just outlined, do you think that justifies policy direction towards more regulation, more disclosure, more burden on companies, or you feel that actually there is some merit in finding a balance, whatever that balance is?
I think there has to be a balance, right? I mean, there could be, so when I talked about politics being costly, it can also be costly from too much regulation as well as the wrong regulation, or too little regulation. So yeah, I think there should be a balance, that there could be too much regulation.
Any other questions from the audience at this point? Yes, we have one right in the front.
Okay, I just wonder how many Fortune 500 company are ESG company. I just have a quick check, maybe 20, says 20 to 30%. But I come from computer science background. I know actually the big giant tech company like Microsoft, Google, OpenAI, etc. They claim to be green, at least, if not ESG, right? Many years ago, but I was told, also I observed, actually they give up the claim recently because they cannot compete, because they are all the big burners of GPUs and things like that. So actually they retreat. They say maybe they have to put the performance first. And then when he reach the performance, and they maybe return to the green or ESG. So to me, maybe, okay, according to what we talk about here is they are at least temporarily trade values for value, right? So something like that. So any comment for that, for this? Because actually the environmental concern is very big for the AI industry as a whole, at least temporarily. But maybe, thank you.
I think that's true for the crypto industry as well. And interestingly, I don't know if anybody knows which state in the United States has the most wind and solar energy coming out. Texas. And West Texas, where a lot of this wind and solar are, is where a lot of Bitcoin miners have moved. So it's interesting how there does seem to be some adaptation, taking into account this high energy use. But I think it's a concern, and you probably have some comments on this.
Yeah, I think so too. So I think when it comes to what you mentioned, it's really what Prof. Laura said, where it's about the definition of indicators, right? About how do you measure the ESG-ness of such companies. Some of those that seem to prioritize returns first actually prioritize environment and climate at the same time. That's the blending of the value and values, because right now, it's very difficult to sometimes pull apart, especially when it comes to climate change. I think as a practitioner, we do see companies that, for example, expand their vaccine offerings because climate change has increased the range of disease vectors. In AI also, if the data centers are not green, maybe it's a concern where they even get the energy from. So there's a lot of environmental considerations within that. Maybe I also like to pick up on that, when it comes to climate ambition. It's a very good question just now, and I would like to tie it to a question that's been submitted earlier from the audience. So those who actually, I think the organizer has polled you for earlier questions. Hopefully I've covered one of those now. That's on climate ambition. And also tying it back to, I think, the second last question, the first question that the audience raised on what kind of data is needed. Is there data indicators that you feel more accurately reflect a company's climate ambition so that investors know whether the company is genuine and not greenwashy? Is it emissions reduction? Is it a score?
So interestingly, I think I recently discussed a paper on, it's called on the important, this just last weekend at a conference, on the importance of assurance in carbon accounting. And the assurance is what made the big difference. It was more important than the target, than if they set a target and if they had the commitment. It was the assurance. Now, the data went way down when they did this test, but it still, I think, is striking that assurance matters so much.
Yep, that's a very good point. I think that's another industry that's booming in terms of ESG and climate change, the third-party assurance, and a lot of consulting firms are actually taking quite a big slice of the pie in ESG as well. I know that we're almost to the end of the Q&A session. Any last questions from the audience? Okay, one more last one.
So I'm not a finance guy or an empirical researcher. So I was still wondering about the main finding was that when the green firms are defined according to the absolute emissions, there seems to be a correlation in terms of return in the green and the non-green firms, the brown firms. But when you take it as intensity that is divided by assets of or sales, and whether you can offer any commonsensical insight why it can be. I would imagine that it's already adjusted for the industry risk and also possibly even the climate risk, right? And this is the premium return over and above. So, I mean, in my simplistic mind, I'm thinking of tech firms versus oil and gas firms. And but you did mention that it's within brown and within green. Is there any insights that you can give in terms of, is it a methodological quirk? I mean, I'm sure these are papers appearing in Journal of Finance and so on. So I'm sure the methodology is very robust and rigorous. Why is this, any insights as to what this could, and maybe that can lead to future research ideas too, in a sense?
So I think it really boils down to this question of definition, and it's the question of is what's important, how far away you are from if we have regulatory actions that say you have to get your emissions down to zero, so then absolute comes into account. But often the institutional investors will use the carbon intensity, and you can probably speak more to this, because they want to take into account that if you have more production, you're going to have more carbon emissions. And so there's this trade-off until you get through the transition. Do you want to add to this?
No, I think you're very right. And I'll just, I think it's what you say is very true. It's about definitions as well. And maybe just one quick takeaway to consider is that if we look at the graph that, the first one you had where green was correlated to increasing performance, it's actually a green, the E score, right, of the ESG. Yeah, so that doesn't really, that speaks to a whole lot of other E factors, not only climate factors, more like pollution control, resource management. So I think naturally it catches a broader sector scope. But if you do a kind of strict intensity reduction, you may actually be looking for, so carbon intensity again as a metric can be, I would like to say it's a kind of a standardized metric, but it can mean many, many different layers. It could also mean that the company is perhaps a little bit slowing down in its whole productivity anyway, which kind of correlates to drop in performance. So there are many layers to unpack within the data, and I think Prof. Laura put it very correctly. It's all about definitions and understanding that variable and really breaking it down. But I think we're almost at time. Maybe I'll just like to pass the floor back to Prof. Laura. Any final words of advice to all of us in the room navigating this huge change, climate change and transition?
So, I mean, to me, I think climate risk is so important and we don't understand it well enough. And so from both practitioners and academics, it's really nice to have more discussions and more consideration of what climate risk means.
That's a very nice way to end off this session. That means we all are encouraged to, I think, exactly what the audience did and asked the questions either before or currently. I think more discussion will only serve to sharpen the understanding of climate risk and financial valuation. So yeah, I think we just keep continuing to sharpen each other along the way. Thank you.
So thank you, Professor Laura and Dr. Joanne, and also our audience for our interesting and sharp questions and candid sharings from both Laura and Joanne. So to express our gratitude for your invaluable contribution to our inaugural lecture, now we invite our Dean, come here again, to present mementos to Laura and Joanne. So Laura first. And then we'll take photos. Yeah, thank you, Laura. Now let's present the memento to Joanne. Can we lastly take a group photo together, 3 of them? Yeah, thank you so much. Please take a seat. So to our audience, thank you so much for being part of the inaugural lecture of our series. We are so grateful for your engagement and hope you gain valuable insights and are inspired to further explore this area. And a heartfelt thank you for our organizing committee here at NBS, also in the control room and online at ECGI and PRI. Thank you so much for bringing this series to life, and I look forward to continuing the fruitful collaboration. Our next lecture will take place online on February the 20th, delivered by Professor Pedro Matos from Darden School of Business at the University of Virginia on ESG investing and green transition. It will be moderated by Stephen Beer from Legal and General Investment Management. So we look forward to welcoming you again next month. Please stay tuned for updates via our website and social media. And lastly, a gentle reminder to fill out our feedback form, which will be available via the QR code on the screen. So we really appreciate your honest feedback to continuously improve the series. So this marks the end of our event today. Thank you so much, everyone, again, and have a very wonderful evening. For our in-person participants, please, we would like to request you to return your lanyard at the designated drop-off point.